Many people have asked how these indicators work, not in more often than terms, and you'll be surprised how once you, in some of the workshops that I've actually given, people actually still miss the slight concept on how they work. So this is about pretty much broken down as easy as I could make it. So in this webinar, we'll be focusing on the MACD oscillator, also known as the moving average convergence divergence oscillator. It offers you and also how simple it is to improve your entry and exit trade. But we also need the free period look back. I don't use the standard 14 period. I find it's too smooth. I like something a little bit more erratic, a bit more noisier, and gives me a bit of an indication, not only on dailies, but as I mentioned, on the 4-hour and 1 hour, which I shall explain in this tutorial, and give you an idea on how vital it is to use it when you're marrying up the two indicators together. Conclusion from this is it will be combined these key indicators in a set signal system for high probability trading and better risk management. And the reason why I said at the beginning is the fact is that the environment that we're going into is pretty much in terms of markets do get locked in strong trends. Now gold's had a very good run lately. Oil has had a massive downtrend from $77 a barrel to the lows of $40 a barrel, and now it's back above 50 now and looking like it's progressing further in a slightly further upward trend. What you should expect to take from this tutorial is the confidence to easily apply what you've learned to your trading and how to use these techniques, and hopefully finding the highest probability of the trades that you're looking for, and feel more confident as well when analyzing the markets, because sometimes you're finding that you may look at one indicator, and if you're looking at too many indicators, then they will conflict with each other, and then it will confuse you, and then you'll probably find that when you put a trade on, it won't or may not be the correct trade at that right time, because it's always essential in timing. This workshop will be invaluable if you want to improve your trading strategy and also learn how to become a successful FX trader. The MACD, as I shall continue on calling it, and also the RSI. So we'll be first of all looking at the two indicators. I shall explain how they work, and then we'll be looking at also some divergence. As I mentioned before, traders can take the advantage of divergence by using a variety of trend-based strategies. Divergence to me is probably one of my favorite trading signals because they are dynamic and most often offer a reliable high-quality trading signal reversal when combined with, of course, other trading tools and concepts. To me, in technical analysis, divergence can be important as a warning signal that also is based on a bullish or bearish trend that's coming near to an end. And from the indicator, you can establish whether or not the trend is agreeable with the indicators or something slightly changing. So we can go into that. And that's a little bit in this, as I mentioned, PowerPoint. So the MACD, the creation of the MACD has, as we know, it can be split into two separate events. In 1970, Gerald Appill created the MACD line. And then in 1986, Thomas Asprey added the histogram to the MACD. Thomas Asprey contributed served to look forward to and therefore cut down on any lag. Because an exponential moving average is used in the MACD, it does lag quite a bit. So what Thomas Asprey was trying to use is something that could possibly give you a crossover which are a deep-seated part of the indicator. So it was trying to look for something that picks up a bit more in terms of momentum. The moving average convergence divergence, MACD, is a trend following momentum indicator that shows the relationship between the two moving averages of prices. It is used to spot a change in the short-term trend and also in the longer term if you're using it, depending on the time frame, of course. Traders use the MACD for determining the trend direction. Now, as you can see, that the first of all is that the two lines was when Gerald Appill developed, and then the histogram was put in place a little bit later, as I mentioned, in 1986. So let's have a look about the construction of the MACD. So first of all, the MACD fluctuates above and below the zero line as the moving averages converge, cross and diverge. Because the MACD is unlimited, it is not particularly useful for identifying overbought and oversold levels, hence why I use an RSI, and I believe putting them two together as a marriage. So when I say marrying them together, the fact is that the two partners work very well together when married. So when I mentioned before is that the MACD oscillates. So there's the zero here and here, right through here. So that's where the histogram oscillates. So keep an eye on that, because when I go through this, you'll see how it actually works. Bullish divergence was the first indication that supported the buy signal for dollar yen and dailies. You can see here that at the time, though, the MACD line and signal line was actually declining with the price. So you're not seeing divergence. But when you actually look at the histogram, the fact is the histogram troughed at the beginning of the chart back here, and then we've got the price declining. So what divergence is in terms of bullish in this case is as price is declining, the histogram is actually going up. Now, when it cuts through zero, either on the way up is bullish, and on the way down is bearish. So you've got a buy signal here, you've got a sell signal here, you've got a buy signal here, and a sell signal here, and a buy signal here, because it's cutting through the zero line. Now I've explained that, now we can go further into this pattern. So first of all, as you can see that you got the decline. Now, dollar yen troughed around 100 at the time when we got a buy signal in place. But while the price is declining, so if you've got a position on, or if you've sold anywhere in this pattern here, as this is declining, this is going up and giving you some kind of indication that something's changing. And be aware that it does, when it does change, as I mentioned, that divergence is a very powerful tool, and it to itself, as I mentioned, is very dynamic. And you can see here that these small candles that are coming down here, once we've got the confirmation of the break, is we got a buy signal very strong here, and then 2 days of buying, slight pause, another day, and then it slightly goes up. Now, where did we turn around here is that if some of you are familiar with outside range days or bearish key reversal days or bearish outside range day, as I was about to go into, this is where the market turned around. They're exhaustion pattern signals. So when the market's rallying and gets to a point that it's exhausted, here's the market drops away. Now it drops away from 107.50, posted an outside range day, confirming the market is actually showing some potential of reversing. And you can see here the histogram did actually top out as well. From there, the market actually sold off and then eventually plummeted. And then you got an outside range day again, and then some further selling into August. The market gave you a sell signal, and what is to be noted is that the first pattern that you can see here as it sold off, and we do say in technical analysis that history tends to repeat itself. Well, as you can see here, history did repeat itself in terms of the pattern. Fact is, the market sold down here and the market sold down here. But look what the indicator was doing. It was going up like before, again giving you a good indication that something was changing in this sell-off. So when the market sold off from the outside range day until it got down to here, the market was short and there was something changing in the trend because this indicator is going up. So let's have a look. As the price goes down, indicator is going up. Bullish divergence, and then you got 2 days prior, or about a day and a half prior before the move. And then we did get the strong move in that candle, but not as strong as you can see here compared to the previous. But following this pattern on, we got a sell signal again. But one thing to notice, now I'll talk about divergence, but when you look at the broader picture of the divergence, let's have a look at this. So you got one divergence here. So as the price drops here, this was rising as it was trying to make new lows. This was rising as it's trying to make another low in conclusion of the actual move. So you can see here, as the market's trying to go down, this indicator was going up. So the broader picture was actually also supporting the fact is that dollar yen did actually rally on. It was the time before Trump came in, so this was October 2016, and as some of us look back on the charts, it did go up to around about 110 to 115 eventually. So the bigger picture gave you the broader pattern of the strength of the divergence. But nevertheless, what we're looking for here is that you can see how this indicator actually works. All you're looking for in the MACD is when it crosses over here, 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 and here. If you're seeing divergence, of course, take and act upon it, because if not, it could be costly to your risk management portfolio, and you'll find that you'll be giving money away when you don't have to, because you can see these patterns coming through, and they are telling you that something is changing in the structure of the whole outlook when you're looking at daily time frame. Now, when trading the RSI, as I mentioned before, you can use the 14 set default. I don't. I find the 14 is too smooth. I find it inconclusive of what I'm looking for. And I find using the free look back, whether that's going to be a 3-day period, free 4-hour, or a free 1-hour look back. So every 3 hours is a look back. So, or every 3 days is a look back. How do we use the RSI, or the relative strength index? Well, the relative strength index is a momentum oscillator that measures the speed and change of price movements, developed by J. Wells Wilder. Now, he developed also the parabolic SARS. He also developed the ADX, which is a directional strength index, which is a trend indicator as well. And how he developed it was it oscillates between 0 to 100. Similar to the stochastic oscillator, by that it identifies overbought and oversold conditions in the market. Getting to know your markets through an RSI indicator can let you pinpoint reversals more accurately and thereby let you position yourself accordingly. As I mentioned before, the default look-back period for the RSI is 14, but this can be lowered, as I mentioned, to increase sensitivity and be raised to decrease sensitivity. And as I mentioned, I use it to 3 to get an idea of what I'm looking at. You'll see what I mean here. Also a note that when you're using the 14 look back, is majority of the people look at under 30 as oversold and above 70 as overbought. For myself, when I'm looking at the free look back, I look about towards 95 to 100 as extreme. It's about seeing the extremeness of the price. This is what you're looking for in this oscillator when you're using the free look back. And then when you're looking when it's oversold, I don't use 30, I use 05, and you'll see where I'm going with this in a second. So trading the free look back. So intraday long is that the free RSI falls below the line 5 axis. Price breaks above the high swing high that formed just before the RSI signal, confirmation of the bull trend. The free RSI drops below 5, and most often you'll find that there is some kind of turn in the price or something changes in the actual current outlay of what's going on, depending on the time frame, of course. Buy on the break of the high of the bullish bar. Now, trading from a short side is that you're looking for when the market goes above 95 is when you're either going to take profits or you're going to start looking to maybe establish a short position, really depending on terms of once we get into marrying the two indicators together, you'll get more of an idea where I'm going with this. Price breaks below the lower swing low that formed just before the RSI signal. Confirmation of a bear trend may be reversing. The free period RSI rises above 95 line again, And then what you're looking for is that's the second confirmation that the market's trying to break high, but it can't. So sometimes buy on the break of the low of the bearish thing. So what I'm trying to say here is that you can also use these indicators as swings as well, but that's in another presentation I'm giving a little bit later on. But for now, to sum it up, we are looking for two RSI signals. So the first one to show us the trend, and the next one to show us the trade. Using the RSI, as I said, as a trading strategy, which look back time frame works for entry and exit signals. So first of all, we're going to look at the hour, and you can see here that I've added the lines on my MT4, so 95 and also 5. And you're looking for extremes. So you can see that when the market got to here as an extreme on the hourly, it tells you that something was changing in the pattern, and eventually it did. And then when it got down to here, something also was changing. But also we look at the midway point as well, which I will get to in a sec. But what you're looking for is for extremes or divergence. And you can see there is some divergence here as well on the hourly. So let's just start this off. So when I was talking about when the market goes to retest the top side of the line, like down here, retesting it, sometimes it can be seen as divergence depending on the current formation of how the lines are laying. But you can see here, nevertheless, that the retest to this top side gave you an indication there was probably one more test, and it did eventually drop away, and quite aggressively. And then from the 2 points is eventually there was some bearish divergence there, and likewise here, some bullish divergence also. Looking at it on a daily time frame. So first of all, we'll look at the free period, and then I'll show you the full team why I don't use it. So starting again, there's your midway point at 50. The reason why I use a midway point is the fact is if it doesn't break beneath there, as you can see here, it's telling you that although the market did peak here, it pulled back, it went to retest it again. It just shows you that the market's in a trend. Remember though, as I said before, this is not just about the RSI, it's about the MACD. So when we marry them together, we can get more of an idea on how they work. So let's have a look. First of all, the market sold off quite aggressively from 1,296, got down to the lows of 1,200. And you can see here there was a little bit of divergence. First of all, you can see as the market's coming down here, is the fact is that although it's not going this way, it's bottoming out. So it's telling you that something's changing quite dramatically. And from there is that we eventually rose or rebound, broke through the midway point and then rallied and got to a point here and then took a pause and pulled back quite aggressively around about $20 and then established. You could say that this in some of my presentations I'll talk about flags and pennants. You could say that this is probably a pennant that basically broke out, so you could use that pattern also. Now moving ahead is that the market finally broke out and then peaked around 1,290.95 here. And the next candle, or the next 2 days candle, is the fact is it took out the 1 day's price action in 2 days and then continued to sell off. And then you've got this whipsaw price action. But the break here was around here that gave it. You may have got stopped out, but you would have re-established the position and still carried on. And you can see here the market eventually got to a point around 5 or just beneath those levels. And then you can see here the 2 points here is the fact is this indicator is going up. If you have missed opportunities here or lost money here, you're looking for the next turnaround in market. Now, if you're looking for a point of where to step in and put the next position on, well, before, just say we haven't got this move yet, and this is where we are at the moment. Fact is that what we're looking for is that the divergence gives you some indication that something's changing in this pattern. If you miss all these candles and you get here, because there was some divergence and you were waiting for confirmation, you got the break here as well, you still would have got on some of that move as it progresses higher. There was a point here where the market got high, but then you can see as we put the pattern in, it was this point here that was showing some indication that something's turning. Now, do take a note on this pattern here. Is the fact is that we've got the point here, which is somewhere around where this doji was, or maybe not quite a spinning top, but close. And then you got this long-legged doji when the indicator's dropping down, and then eventually the market did sell off. So a good indication of getting out of your longs, because this is the point, or even taking some profit, knowing when to take profit. So for argument's sake, even if you got in around 12.35, say, you still would have got out somewhere around 60. So you still would have got about $30 worth of rally in that trading session. But the diversions coming through is that you should be start unwinding the trade as the days are going on. Or the other way you could trade it, of course, is by raising your stop each day. Always, every day, I would look at the market around New York close in the morning, which is around 7 or 8. And I adjust my levels of take profit and also stop losses, because you will lose the opportunity if you don't. What I'm saying is, if you put the position on there and you rode it all the way there and just say the market plummeted, it has done before, you can see quite aggressively in the past, even here, very big day. Is the fact is, if you're not raising your stop losses, then you're giving away money back to the market that you made, and that's not what you're trying to achieve here. So it's always good to add some points in your trading. And the fact is that every morning, always change your levels when it comes to take profit and stop losses. Because the reason behind this is, well, if you are lifting your stop loss every day, you may raise your take profit. Who's to say that the market may have continued like it did here? But where you're going to catch yourself in terms of profit is that you may not get set here, but this is right. You're rising this every day, and eventually you'll get taken out with a profit. And you haven't found that the trade was a waste of time. And the other thing as well is that you found it went through the 50 midway point and continued on. And I think from the memory serves from this pattern, it did actually drop further to the 1,200 mark. Now looking at the 14-day or the 14 look back, the market is just in this sell-off. Well, how do you act upon it? I can't act upon it, really. It's very difficult here. It's telling me it's oversold. And the fact is that when you're looking at this point from here to here, is it's sold quite significantly from around 12.10 down to about 11.25. This indicator was no good to me whatsoever. And if I just go through how I've outlined it here, there's a 70, there's your 30. So you're overbought and oversold. Some indication the market did get you long there, granted. And also the market got you somewhere short there. But do remember, look at the size of the ranges. Is in that day, it was like close to like $35 in a range of one day. So whether you could trade that, whether you're selling into that rally, how far can you sell into it? The point I'm making is that the line is too smooth, and in terms of the free look back. So I'd prefer, and over a period of time, try it out and see how you find it, and you'll see what I mean between the two time frames that you're looking at, or the look back, should I say. The divergence was going for a very long time there in terms of how it was setting off, and eventually you got to a point, not the best of divergence, because the indicators should be going more the other way. The indicator, if we just cut this out, the indicator should be going more that way as it's coming down. The point, the reason why I put the divergence there is the fact is, when I get this to work, is the market was selling off, but there wasn't making any real new lows. So when the indicator sort of starts bottoming out, that is a little bit of divergence, but I would like to see the indicator more swaying the other way. A little bit on divergence. As I mentioned, divergence is a powerful tool. Divergence occurs when the pattern disagrees with the indicator to the price action at the same period. It can be significant to your trading, and also it is significant to the fact that if you need to get out at the right time when you're seeing these divergence, something is a warning signal. It's like saying red alert, in a sense that the market's looking like it's going to be changing. Therefore, you do need to adjust your stop losses and take profit in accordance, or just cut the trade or put the trade on, depending in terms of how you're seeing this divergence. Divergence is when, as I mentioned before, is the price is moving in an upward direction, but the indicator is moving in a downward direction, or vice versa at the same time. Divergence can be found in momentum indicators or oscillators only. An RSI and MACD divergence, well, technical indicators work best when you use them together, combine them as a signal system to a broader trading plan. The best trading plans are simple, using a small number of solid technical indicators along with a few other proven tools and techniques. Too many indicators on a chart confuses things, sometimes even giving you contradicting signals. And this is when you start losing money, because you're looking at too many signals, and you should really break it down to just a couple. I use the RSI, I use the MACD, and also I use an ADX as a trick to give me an indication what the market is trending or not. Popular technical indicators are popular because they work, and also because if enough people use them, they can become a self-fulfilled prophecy. Remember that there is a lot of analysts or a lot of traders out there, and they're all looking at the same patterns. So what tells me is that they will follow that. But trying to master them and changing some of the time frames, you can put you slightly ahead of the actual market itself, knowing when there's going to be a turnaround. Hence why this webinar today, and hence why I like to use the RSI free look back. Just a little bit more on divergence, because some people do actually miss the concept of what it's telling you. Divergence assists the trader to identify and react appropriately to potential price change. Therefore, the trader must make a decision about the trade by either taking profit or moving the stop loss. Seeing bullish or bearish divergence increases probability by alerting the trader to protect his position. So how to identify bullish divergence? After a long downtrend, prices create lower lows, but at the same time, indicator creates high lows. Acting upon this pattern or signal, we can identify an upward or a downward reversal. So giving us entry opportunities for long or short positions. Finding that entry signal. Now, the first steps to finding an entry signal involves examining your charts. If you've had a Twitter come out by Trump, if one of his what I call so-called advisors, and that's Larry Kudlow, I mean, there's a few of them out there, they seem to be sort of just harping on and actually contradicting each other. I found over the past, some things that things are said, they seem to come in and clear up the mess and say it's true or not true, or you've misunderstood, or something along those lines. And it does affect the markets. And so by using these indicators, we can find out whether or not the market is really true in terms of how the pattern's moving. And then we've got to find somewhere in this mess that we have at the moment, purely for the fact is how the world is going at the moment. In my 28 years of trading, I found this is one of the most challenging times. And I've been through quite a lot, like 1987 crash, 2000, September 11. There's been quite a few planes shot out the sky. I would say that this is probably one of the most volatile times we're seeing, especially saying in December that the markets were pretty much, as the year ended, one of the worst since late depression in the 30s. But on the flip side of that, we can use these opportunities to take advantage of them, and this is what I'm trying to assess in this tutorial today. to show you how these indicators can actually work. So firstly, you would need to decide the best asset pair to trade and then examine the daily charts first. You should do this around the same time each day. So say you like to trade Aussie, or say you like to trade dollar yen gold, and each morning at New York close, it's always good to assess what the markets did in New York. Whether you're looking on a 4 hour, 1 hour, I start with a daily because I like to see what the pattern tells me and then go forward from there. Okay, to answer your question is that the MACD on the MT4 is a default MACD, which isn't correct. So the MACD I'm using, it's called a true MACD. It's the one that's set up. You can, if you talk to your account manager or one of our friendly staff at USG, they will be able to give you more information in how to access this MACD. But you are correct. You beat me to it actually, because I was going to show you at the end of this PowerPoint exactly where the two MACDs differ. So, but to get that MACD that I just showed you, you would have to speak to one of our friendly staff, and they'll be able to give you some more information on that for you. The best time to analyze your daily charts, as I said, I like to look daily, is between New York close and once again in Europe time. So that's roughly in the late afternoon of Sydney. This is when the market action dies down from the previous day and the new day begins in Asia, and typically is not active as the New York or European session. You'll find sometimes in Sydney it's very, very boring. Consolidation. Not so though at the moment with all the excitement that's been going on just recently with all the trade wars and the list is endless. North Korea, and there's so much out there. So price is making lows. Look what the oscillator is doing. It's going up. Hence, price go up. Prices are making highs. Oscillator's going down. Eventually, the market turns around. So I think you've got the idea. Let's have a quick look establishing the trade. So you should be mainly looking for the following things: trends, support, resistance levels, and determine the recent price action, whether or not you want to take part in the trade or maybe wait. It's about opportunity. When it comes to opportunity, don't always feel that you're going to miss the trade, because the way I look at it is if you get in too soon, then you've got to put the fire out because the trade isn't correct. And so this is what most traders look for in patterns. So in bullish divergence, when the price is going down, indicator's going up, it snaps to the upside. Again, when the price is going up, the indicator's going down, drops to the downside. And what I mean by if you put the trade on too soon is the fact is, that's in the next slide, so we'll just get to it in a sec. So after you determine whether the market is trending or consolidating and drawing essential support and resistance lines, I would then look for obvious price action signals forming within the structure of the market. Myself, I like to trade with the trend as much as possible and from points of value, as in support and resistance. Where is support? Where's the resistance? Is the market finding these levels prior as a support level, or was there no support at all and the market would just crumble and fall, or vice versa, take out the resistance and rally? But sometimes the market's not trending, and at these times we can look for price action setups near core support and resistant levels in order to trade a range-bound market for counter trend setups. As I mentioned before, the RSI can detect prevailing trend directions by center line crossovers. This center line of RSI is at 50. When the RSI is above the center point of 50, the trend is up. Inversely, when the RSI or the market's below 50, then of course it's telling you it's in a downtrend. Now, as I mentioned before, this is how I look at myself when I'm putting a trade on. I like to feel that I'm in control. I'm putting fires out easily. I'm not running around. I'm not looking at my position every 2 minutes. If you're looking at your position every 5, 10, 15, 20 minutes, or something's wrong in that position. You haven't got the right trade on. So that's not how I like to trade. How I like to trade is knowing how to be ready for the trade when the markets move against you, and you're prepared for that. So you use these indicators to give you an indication of being prepared. So follow the trend, follow what the market's telling you. Look at your instruments, seeing what they're telling you as well. Understand what it means by setting up a trade? Well, I did say at the beginning I was going to talk very small on risk management. Risk management may seem a boring subject, but without it, many of us as traders could see our profits quickly dissolve into large losses. Attempting to trade by only concentrating on your entry signal is like having a one-legged stool. You need all three legs to make your trading active and make it work. What is the three-legged stool? Well, success is where you sit on. Technique, approach, and mastery. Technique, well, the technique leg is comprised of the markets you trade and how you trade them. The approach is when this incorporates the entire variety of trading psychology. Mastery, well, you can have the greatest trading methods along with the total emotional control, but you will fail to succeed if you are not totally familiar and proficient in what you are doing. Understanding what it means to set up the trade. Well, trading in the financial markets requires two great skills. Two great skills. The first is the prediction of the underlying market move. And second is the ability to risk manage the position you hold once you have completed step one. Many novice traders are well aware of step one, but often overlook the risk management part of the trade. However, the risk tools often will determine whether the trade is successful or not. Seem to have a sticky button. Okay, I chuck this in here. If you ever see shooting stars, you ever see any type of doji, you ever see outside range days, you ever see any kind of signal when it comes to trading with candles, you need to have confirmation on that signal. Don't jump in, because if you find that you see an uptrend like here, this candle's bullish, 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 shooting star, and then what happens is that from the shooting star, so when just a brief description on the shooting star is the body of the second candlestick must be near the low at the bottom end of the trading range, and the upper shadow must be taller. This is also a weak reversal signal than the morning or evening star. The pattern requires confirmation. A lot of candlesticks require confirmation. Where you get that confirmation is because here there's no confirmation of the signal. If you put the trade on here, what happens is it may go higher, higher, and higher, and you stop out and you didn't find that was a successful trade. By this way, if you get the confirmation, wait for the market to close under this candle, which is half the value. If it does, there's a tick in the box. If the indicator is also dropping down, there's another tick in the box. You should be putting the trade on, and then hence it should continue to fall further. So do look for these signals, but confirmation is what you need before putting the trade on. The effective use of technical indicators. It's never a good idea to make trading decisions based on a single indicator. As I said to you before, the MACD does not tell you when the market's overbought or oversold. Technical indicators work best when you use them together, combine them as a signal system. And that's what you're trading, is a signal system. When you set up your MT4, is that you're creating a signal system to give you an indication of the broader trading plan. Common technical signals, like before, if everyone follows them, they do become a self-fulfilled